Good morning, everybody. Thanks for joining us on this Structured Products conference. Let me start by giving a quick introduction about myself. So my name is Jan Talsma. I work at ING. So I work in the CSG Investment Solutions group. I have been working in the structured products industry for almost 20 years. So I spent most of my time at Citigroup. I worked there on the buy and the sell side, so both on the private bank side, retail bank side, and on markets, and always around equity derivatives and structured products. And on this conference here today, I'm going to give you a bit of a overview of what we do at ING and what our group does, and a bit of an overview of how the Benelux market is looking at the moment. And then we'll go through a couple of products as well, which we've seen becoming very popular in this part of the world, and also a little bit of an educational piece on how these products are being structured. So I've got a couple of slides here. I won't go through all of them. So some of them I will go a bit faster on because I appreciate the main topic here is structured products. So this is a bit of our presence within ING and in Europe and the rest of the world. Here in particular in Europe, obviously we have offices in Warsaw and Katowice as well. We have our retail bank in Poland, Bank Śląski, and basically we offer a different range of products across the world actually. And within Poland, we are primarily focusing at the moment on our leverage products. So if you see here basically the whole spectrum of products which we cover. So at the bottom on the left hand side, you'll see the most conservative products are the fixed rate notes. Fixed rate notes are basically plain vanilla interest rate linked products. So that has become very popular lately. I'll explain a little bit more on the slides later on why these products have become so popular. And you basically go up on the risk curve, but also on the expected return. So you have capital protected products, yield enhancement notes. Those two products I will spend a bit of time today during the presentation. And we on the furthest on the risk curve and the expected return is the leverage products. My colleague Bartosz will give you an overview of that a little bit later on. So that is a product which we are very active on in the Polish market. But this gives you an overview of the products which we offer on our desk and which we distribute across the globe. And I'm responsible for the EMEA part of that. Then an overview of our group and what we do. I won't go into much detail on that, but basically it is a bit wider than just offering investment products to retail. We are also involved in strategic equity solutions. I think about stock buybacks, etc. As long as there is a derivative element involved, then we have some involvement in that as well. Then if we look at the structured product side, I think this is an important slide to go to. I mean, basically on the client side, so our mandate is the easiest way to how to explain it is basically as long as the end client is a 2 lakh individual, then the product which we offer can come from our desk. And basically we always start looking at the client needs, so the need for a client, and when a structured product becomes in the picture versus a mutual fund or a deposit or any other investment product where the client has access to, is we're looking to optimize the risk return ratio of the investor. Um, with these structured products, the client has the choice to choose the protection that he needs. So some clients need no protections at all and needs a very high exposure, if they want to have a leverage for the market. So that is the product set, which Bartos will explain you a little bit later. But when we look at other structured notes, we always sort of try to find ways where we can protect part of the capital, or we can actually protect fully the capital the client invest on day one. Then the client needs to choose what market do I want to have exposure to. Is that the European market via, let's say, the Euro Stoxx 50, or the US market via the S&P 500? And then also, it's very important, what is the sort of tenor that the client is looking to invest? So does the client want to invest for 3 months, 6 months, 12 months, maybe 5 years, maybe even 10 years? So those are the sort of ranges which we cover. And then the key thing with structured products is always that on day one, the payout for the product is defined. So you know exactly what your payout is going to be. If the market is moving this way or that way, you will know what your payout is going to be. So really look at structured products. I always think the best way of looking at it is it's basically like the Swiss Army knife of the financial industry. So you can have a wide array of features designed to meet the investors' need. So then on the right-hand side, you'll see the solutions which we can basically offer to the clients who have those needs on the left-hand side. And that's how the design of the product starts. So we look at what does the client needs, and then we'll find the solution which ticks all the boxes which we have on the left hand side here. Some clients want to have a very risky product, so it means that we don't embed any principal protection. And other clients, they are very conservative, so they want full principal protection. And then the other thing to consider is how do we offer the product? Do we offer it in a note? Do we offer it in an OTC format? So basically, the delivery vehicle from a structured product can be different every time. So then you have 3 steps within it. So once you fully designed the product, you know how the product is going to look like, you know the tenor, you know the principal protection, you know if it's going to be a note or it's going to be a fund or an OTC. Once we have defined all that, we have a couple of steps in the pre-trade side. Then we actually trade the product, and then we have post trade. And then all these products which we offer, they have a secondary market, so the client can buy and sell these products on a daily basis. So that's the part which comes under the post trade side. Then this slide here gives you an overview of the different products, so i.e. the different wrappers. So we have structured notes here, OTC options, swaps, or warrants. And warrants would be our leverage products, which Bartos is gonna go through a little bit later. Then on the tenor, we offer the products between 3 and 10 years, 3 months and 10 years. Well, what I just explained. Then we have a product which is called auto-callable or issue-callable. I'll go a little bit later into detail of an example of an auto-call product, principal protection, and then so you can have a 100% principal protected product, a partial or a conditional capital protected product. We offer them in different currencies. So obviously we offer them in Polish zloty, euro, dollar, GBP, basically any currency the client wants. We have reference assets, so we can offer products linked to equities, interest rates, credits, or mutual funds. And then the products which we offer depend on the market outlook which the client has. If the client thinks the market will go up or down, or the client thinks the market won't move, then it would be a so-called market neutral investment. So that is basically in a sort of nutshell the sort of how do you build the product, how you design it, and how do you actually deliver it to the client. Then we have a lot of experience in offering these products to the different regions. So I am based here in Amsterdam, so I thought it would be useful to give you a little bit of a flavor of who's actually buying these products and how does it work in terms of popularity. Are these products popular? And the answer on that is actually yes, they are. They always come in waves, I would say. Depending on the market scenarios, you'll see these products becoming more or less popular. What we tend to see is that when interest rates rise, these products become actually more popular. And the reason for that is because you can offer principal protected products, and we actually can see that in the sales numbers as well. So if you look here on the first graph, you see the number of products issues. Not really a lot has happened um, in that. You see basically the number of products issued per year is around, like, it's gone a little bit down. It's around like the 1400 products. So this is across the Belgium, Netherlands, and Luxembourg. And for that, you have to keep in mind that if you look at these three countries, by far the Belgian market is the biggest market. So that's a really a structured product. A structured product market. And um, so of these numbers, I would say 80 or 90% is the Belgian market. The Netherlands market is a smaller market. And also, the other big thing is the numbers which you see here are all for public offers. So that is those are the numbers on which we have a good view. Those are the numbers which we can see in the market. Private placement market. So those are that is the market which we have a less of a picture on. So I cannot show you numbers for that. But basically, the key thing here to notice is that you see that the sales numbers have gone up quite substantially in 2023. You see here that basically numbers have gone down each year, and then suddenly in 23 you see the numbers going up. And the reason for that is if we so here you have the number of outstanding products, so you see it going slightly up, and then the notionals is also going up substantially in 2023. The reason for that is if we look here on this slide will give you a breakdown of the underlying asset classes. And we've seen that traditional with structured products over the last couple of years, it's been really equities which has been the bulk of the products. And fixed income has always been a smaller part of the business. But now with rising rates, it basically means that there is more interest in interest rate linked product because rates have been very low for a very long time. They've been basically negative or they've been zero there. So there's no real interest in that. So, and because there was no alternative, so basically people just were piling into the equity markets, and they were doing this either on the cash equity market or via mutual funds, or they were doing this via structured products, mainly via auto-callable structured notes, which I will go through in the next slides. But basically now, because of interest rates have gone up, we see now in 2023 the split on these asset classes has been 50-50. And I will give you an example of one of those products. Then in a later slide, then we have a couple of key factors which determine the pricing of structured products. And I think this slide is very important because it will give you an overview of why these products have become so popular, and actually why now today is actually the best time to have a look as an investor into these products. Because we see here on the first slide, we see equity market going up. That's always good. If equity market goes up, people have interest in investment products. If equity market goes down, people just prefer to sit on the sideline and don't want to invest because they just feel like, okay, if I invest into the equity markets today, I will lose money. So that has not been the case. If you look over the last 10 years, you see it's basically pretty much in a straight line up. We have seen, or we have seen during COVID, there's been a bit of a blip. So market went down, but they recovered very quickly up. You see that also here, fixed performance. Fixed is basically a measurement of the volatility of the equity market. So generally, when the market goes down, volatility goes up. Volatility means is a way of expressing the uncertainty in the market. So we've seen around COVID, the volatility went up quite a lot, but then it came down again. Now we see it here at this level, so it's almost it's trading around like 15 mark. So that is really very low. If we look historically, average is basically trading on the lower side, and volatility is also determining is also one key factor for determining the price of the option. So basically, you want volatility to be if you buy an option, you want to be volatility to be low. If you sell volatility, you want it to be higher, basically because you're receiving the premium. And if you buy the option, you have to pay for the premium. So you want the volatility to be low. Then on the other hand, here you see swap rates. So you see basically everybody has heard, have seen the news of inflation, and basically a way to fight against inflation is to have higher rates. And that's basically what central banks have been doing across the globe. They've been hiking rates. So we've seen since 2021, there's a huge spike in interest rates. And then the other factor here is the 5-year CDS rate. So this is the CDS rate of ING. So this is basically, so you have the swap rates, and in addition to attract capital as an issuer, which could be ING or any other counterparty, you have to pay a premium above the risk-free rate to attract capital from investors. And the CDS rate is a good indicator of what is the risk perceived for investors holding ING paper or any other paper, because basically this rate will give you it gives you a premium, and that's the premium you pay to insure against ING debt. And so basically the takeaway here is the lower the number, the safer generally the outstanding bonds are to hold as an investor, because this is basically giving you the insurance premium to insure against the default of the underlying debt. So the conclusion here is we have a rising equity markets, we have a rising rate market, and we have falling of equity volatility. So fixed basically goes down. So this is a these are perfect circumstances to issue a principal protected note, and effectively that is what we see in the market. So if we see at the moment in the Benelux, the most popular equity products are simple participation products with 100% principal protection or 90% principal protection. So here you see a couple of examples from products which have been recently issued by the different distributors who are active in those markets. And here I have a slide which basically shows you a little bit of what is under the bun of an equity linked note. So what's inside an equity linked note and what is inside a principal protected note. So basically the structured note consists out of two components. One is a zero coupon bond, and the other one is an OTC option. And on day one, you invest 100, let's say we take 100 euros, you invest 100 euros, and of that 100 euros, 80 euros goes into the zero coupon bond and 20 euros goes into the underlying equity option. And that zero coupon bond does not pay a bond, but you buy that bond at a discount. So let's say you buy it at 80 and that one will grow to 100. So instead of getting every year an return for holding that bond, you don't get any coupon. That's why it's called a zero coupon bond. But the issuer will guarantee that it will pay you 100 at maturity. So what you see here is on day one, we invest 80 euros into the zero coupon bond. We know whatever will happen, that one will grow to 100. So subject the issuer won't default. This part will become 100, and then the other 20 euros which we invested into this equity option, this is going to give you the underlying return on the structured product. So this 20 will hopefully grow to 50 or will grow to 100 or whatever it is. But in worst case scenario, this money will be is gone at maturity if the underlying goes down. So basically, with an equity option, it will give you all the return or it will give you nothing. If it gives you nothing at maturity, so then what has happened? This 80 has become 100, so you will get your 100 back, and then the option part basically doesn't pay out, so you've lost all your money there. But in best case scenario, you get your 100 back plus you get your option payout. So that's basically in a nutshell how a principal protected note works, and we see an example of this one here. And that is basically it's giving you the building blocks, and this is a product which has a tenor of 3 years, and it will give you 100% participation in the underlying. So that's what you see here. Here in this at the right hand side, you'll see the diagram, and you see basically if the underlying goes up, you make money. If the underlying goes down, you get your principal back. So here in worst case scenario, the underlying goes down, but you still get your 100 euros back, which you invested on day one. So there's only upside. There's no downside. In worst case scenario, you get at maturity, you get your 100 euros back. So that's an example of an equity linked note. Then another product which is very popular on the equity side is an auto-callable note. Here, basically, what we do is the investors need to have a moderately bullish view on the market, and if the underlying goes up, you get a predefined return of 8% per annum. So you look here at the diagram on the right hand side is if after year one the product is above initial level, you get 8%. Then after the product gets called, so the client gets the investor back. So you invest 100 euros on day one. If the underlying is above initial level after year one, you get your money back plus 8%. If not, the product continues to the second year, and you get twice the coupon. And this repeats until maturity. So in best case scenario, this product is for 5 years. At maturity, if the underlying is only up above initial level, so it went up by 1%, you make 5 times 8% coupon, and you get your principal back. This product, however, does have downside. If the product does fall by more than 50%, then you lose whatever the index is down. So if the underlying index, which is in this case is the Euro Stoxx 50, is down by more than 50%, then you lose more. You lose basically more than 50%. You could potentially lose all your principal if the underlying goes down by 100%, which is obviously not going to happen. But you can have a scenario where the underlying loses more than 50%. Then, in the interest of time, I will go a little bit quicker to the rates products. So the other products which we've seen really become very popular in the market is the fixed rate notes, the fixed callable notes, fixed to floating CMS rate notes. So these are products which are much more conservative. They are by default principal protected notes, and they will pay a performance which is linked to the underlying reference rate. So think about products with paying like 3% or 4% in euros fixed every year, and there's no contingency, so it's not linked to an equity underlying. And obviously in Poland these levels would be much higher because the interest rates in Poland are higher. Here is an example of a product which provides a coupon of 3.4% in the first 3 years, and then from year 4 to 7, it will pay you a coupon which is depending on the CMS rate. It will pay you 80% of the CMS rate. So let's say the CMS rate is at that point, let's say it's 10%. If you get 80% of 10%, so you get an 8% coupon in year 4, 5, 6, 7. But the first 3 years it's fixed. You know what you're going to get. These products are extremely popular in places like Belgium. So yeah, we're already getting slowly to the end of the presentation. So just on the closing remarks, this was literally in a nutshell. I appreciate that went like very quickly to the presentation. That this was really in the interest of time. But the way how we see the structured product market developing over the next couple of years is that we, as long as interest rates are high, we see more principal protected products coming in the market, and if equity markets continue to do what they do now, we'll see principal protected products linked to the equity markets, and otherwise we'll see more products linked to the interest rate market as well, i.e. fixed rate notes and the CDS CMS linked products. Let me think. Have I missed anything? No, I don't think so. I hope you enjoyed this presentation. I hope you found it useful. Obviously, our contact details are shared as well. So if you do have any questions about any of these products or anything about ING in general, please do not hesitate to reach out to us. And otherwise, enjoy the rest of the day.